This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 233, which is our annual year-end episode. And it's incredible, Ben, the end of another year.
It is incredible. This one flew by. It feels like the time goes faster as more time passes. You probably know that better than I do.
I appreciate that. So this is our fourth time we've done this year-end episode, where we basically patch together segments from all the guests we've had this year in an attempt to weave together a story of 2022 from our vantage point. Not an easy job to do because we have many hours of interviews and conversations, and we want to make sure we include everybody. Give it our best shot, though, just the same.
Yep. The year was... This year was crazy. I mean, we've had every year we reflect on the podcast. It's like, man, you know, we're blown away by the people that were willing to come talk to us, and we're blown away by the conversations that we had, and all that kind of stuff. But every year it's the same kind of feeling where it's like, man.
Yeah, man, how do we find these people? How do we get them to come on, and then to be blown away by people when they do arrive? It's just such a incredible experience.
Yeah.
So speaking of incredible, the numbers for 2022 are also pretty incredible. Podcast downloads last year were up 48% over 2021 to 1.85 million. YouTube views up 46% over 2021.
Wait, that's crazy. That's the 1.85 million downloads for the calendar year 2022 to date, right?
To date, compared to the same to date last year. So
last year is when we hit a million. Was that 2 years ago? When did we hit a million total lifetime downloads?
I've lost track.
I remember that was a big milestone.
Yeah.
And in 2022, we almost doubled that in the year.
Yeah.
That's
so
crazy.
Both audio and video are both up 48 and 46%. So 515,000 YouTube views, 19,000 YouTube subscribers, which is still nowhere near what your Common Sense Investing channel is at, which is over 200,000 subscribers, I think.
It's 294,000 at the moment.
It's almost 300. Incredible. In the community, 8,173 members in the community. And in the store...
The community, sorry to interrupt you, the community is 8,000, just over 8,000 members, but very active. Like the software tool Discourse that we use for that platform, it tracks the monthly page views. That's one of the metrics that the software tracks and that our plan is based on. Like if we go over a certain number of page views, anyway. But the page views is consistently over 500,000 per month, which is a ton of. Like if you compare that to activity on a website, it's like insane.
Yeah. In the store, we had 230 orders this year, and by far the most popular items were Talking Sense cards and the T-shirt. So super happy about the Talking Sense cards popularity. For the reading challenge, this was interesting. So the 22 and 22 challenge, which we will be continuing into next year, the 23 and 23. We had 592 people sign up. We have 355 active readers. These are people who logged their reading. 65 people completed the challenge, the 22 books, and the total for the community was 3,776 books were read. And 80% of the readers said they read more books this year from joining the challenge, which is pretty cool.
Mm-hmm.
We had our first live meetup in London a few weeks ago with over 20 friends coming out. That was an incredible experience. And we heard from so many people on all sorts of different platforms, be it LinkedIn, YouTube, Twitter, people phoning us out of the blue. So we did our best to mention as many as we could. So if we missed your reach out, we apologize. It did become a bit of a challenge at a certain point to keep track of everybody. Maybe you want to give a shout out to the moderators in the community, Ben.
Yeah, sure. So Dan, FFA, and Anarchy and Marco, they make the community happen. I think I've seen that comment a few times about the quality of the Rash Reminder community and the quality of the discussion. being related to the fact that it is a heavily moderated community. And I think that's accurate, and that's because of those moderators, and also Angelica helps out with the moderation too. So big thanks to them. They make that place what it is, or at least help make it what it is. Of course, the users contributing content and discussing stuff really make it what it is.
You bet. And you mentioned Angelica. We have to give a shout out to our marketing team led by Martin Dallaire. Angelica Montagano is our digital marketing lead, instrumental in all things podcast. Sandrine Dugray, who's our digital marketing coordinator, who does all the posts on Instagram, etc. Matt Gambino is our multimedia specialist, so he's the man behind the YouTube videos, and there's a tremendous amount of work that goes on there to pull these videos together with the graphics and whatnot. I also want to give a shout out to our compliance team led by Karine Deland. So she's our chief compliance officer, as well as Russ Mitchell, our senior compliance officer. So of course, everything has to go through compliance before it goes out. So we really appreciate the support that they give us.
That means our compliance team has listened to every single episode.
Every minute of every episode, and in a very timely fashion. So we really do appreciate that. Have to give a shout out to our incredible producer, been with us since nearly day one, Matthew Passy at the Podcast Consultant. He has a whole team that does great work with him, and we're very grateful to Matt and his team. Want to thank Quinn McGraw on Matt's team for great work, as well as Shannon Rojas, who is their chief operating officer at the Podcast Consultant. So this team is obviously very instrumental in keeping the production of this whole thing moving along, including show notes, etc. So we really appreciate that team. Shout out to our merch supplier, Jen Beldam at Northern Craft, and also our phenomenal sock supplier, Sachin at the company Eversocks. We really appreciate his support. Again, we've had many orders from them for many years now, so we keep shipping out lots of socks. Shout out to the University of Chicago Financial Education Initiative, who helped us make the Rational Minder branded Talking Sense cards available. So we shipped out this year, I think, over 200 decks, and there's another order on its way. The original music that we use was created by our good friend Trevor May, so thanks to Trevor. But clearly, most of all, we want to thank the audience that listens to us every week, which is amazing. The numbers just keep increasing all the time.
Yeah, it is. The audience growth really is humbling and incredible.
Yep. So 2023 is going to kick off with a bang next week, as we mentioned a couple times, with Nobel laureate Robert Merton coming up next week. And then we have a whole slew of unreal guests lined up right through March. I think we're booked now, right?
Yep.
All right, Ben. Anything else to kick off this year-end recap show?
I don't think so. Well, lots of great clips to cover to wrap up the year, and hopefully remind people about some of the great conversations that we had throughout 2022, and maybe some people will go back and listen to the episodes, which is something I know you've been doing, Cameron, because you've been doing the episode summaries. It's something that I've got to do more of. So many past episodes you go back and listen to, and it's just mind-blowing how good the conversation was, but our brains aren't good at retaining stuff like that for long periods of time, I don't think.
It's funny you mention that, because that's why I'm so curious when we interview people to talk about books. How do they capture what they learn from books? Capturing the information from these podcasts is hard. And I remember someone was at the meetup in London, and they had a whole system that they were showing others there how they're capturing notes in, I think it was OneNote or some other note platform. And it's just so impressive and so much work, but to have that recall from so many topics, it's not easy. And every week it's just another episode just keeps on coming like a river, right? And it's a job to tease out of this what might be applicable to you. Yep.
No, definitely. Yep. Hopefully we help with some of that by doing this recap. But it's a field of that's a professional field, knowledge management. It's like an area of study but it's not easy. It's a hard problem to solve.
Exactly. All right. With that, let's go to our year-end episode 233. So we sure kicked off 2022 with a bang with a perfect guest with Mac McQuown joining us. Mac was so instrumental in the early days of indexing, which we learned from him that it had everything to do with the revolution of data. The curation and organization of data completely changed the game of investing. So, of course, we had to ask Mac about that era, which, frankly, to anyone today is unimaginable that the data wasn't available to have an index, to compare an active manager to an index. So I thought Mac's insights on that were just sensational.
Well, data upended the whole topic. When I reflect back on the finance I was taught in graduate school and with my MBA, I majored in finance, and it was for all intents and purposes devoid of data.
Wow.
In large measure, that was because there weren't any really important scaled computers. In fact, when I was in business school, there were, as far as I can remember, there were no computers whatsoever on campus. And that's not, it was, that of course was a long time ago, but if you stop and think about the revolution that got created by computers and the data, of course, followed from computers. And then, of course, analytical procedures and ideas became the quest. And I would say both data and analytical procedures are still at the middle of the quest. Now, it's changed a lot because we've gotten more sophisticated, but in a nutshell, we're still after data and methods of analysis.
So you went to Wall Street in 1961. You mentioned your studies being relatively devoid of data. What was it like when you got to Wall Street?
Well, it was even more devoid of data. As a matter of fact, I have a kind of a funny one about that point. I went to work for a well-known investment banking firm whose name I'll skip over because the next point that I want to make is I was questioned by one of the senior execs I was being interviewed by before they offered me a job, and of course before I accepted it. And his question to me was, why would an engineer want to go to Wall Street?
Wow.
And I'm not joking. That was a question that he was posing me and expected me to say something. Well, I was already clear from work that I had been doing across the river from Harvard at MIT that data was going to be that story. And that was just serendipity that I got exposed to that professor and that early data. And the data I'm referring to are weekend share price for a collection of 50 initially, and then a couple of hundred stocks on the New York Stock Exchange over a period of quite a number of years. And if you stop and think about it, that today is kind of the holy grail of where analysis goes. And of course, we not only have weekly data, we have even hourly data on some equities from some markets, but we have data from something like 50 markets around the world. And I think a lot of that data goes back at least a decade, if not 5 decades. So in one lifetime, mine, that game has totally changed.
Like you said before, Cameron, it's hard to imagine today a time where engineering and math was not part of Wall Street. It's completely incredible to think about. Our next clip ties into what we just heard from Mac. It comes from Robin Wigglesworth, who wrote the book Trillions, which was like the history of index funds. Back in the 60s, there was no way to know how your portfolio was performing. Again, believe it or not, you get hard to imagine today that there wasn't the data and the systems to track performance. There was no market to beat. So Robin told us about that era of finance and what it was like back then.
almost a weird thing for us today to think about this, but there were indices, but they were by any sort of modern standards laughably, comically rudimentary. So you have the Dow Jones Industrial Average in the US, has a venerable history. Wall Street Journal bizarrely still quotes it, even though it has a terrible construction method. It was basically to sort of measure the strength of the economy and some industrial stocks. It wasn't really until the 50s when the S&P or Standard & Poor's launched a market cap weighted index of the 500 biggest companies that you had a almost real time. It took a decade before they could calculate it within minutes, but at least every day, real time gauge of what a broad swath of the US stock market did. But even then, people didn't know what the long-term return of stocks was. People literally didn't know that. So the genesis moment was when Merrill Lynch, that wanted to sell stocks to ordinary Americans and households, to a generation scarred by the Great Depression still in the 60s, was going to run an ad in every newspaper in the world, in the US, saying stocks are a great long-term investment. And the SEC told them, no, you can't do that. You have to prove that they're a good long-term investment. So they basically handed a wedge of money to Jim Laurie, a professor at the University of Chicago, and he started a new project called CRISP to research security prices, essentially Center for Research of Security Prices. And he spent years doing this because he manually had to collect, him and his colleagues had to manually collect the prices of all stocks they could find in the US, equalized for different tax treatment in different countries, dividend payments, and also just the fact that some things that were called a common stock were in fact not a common stock, and other things that were maybe called a preference share or even a bond actually was common equity. So they had to do all this work and clean up the data, and it took years and cost a lot of money, but they were the first people that created this wonderful, nearly magical database of security prices in America that proved that stocks were a great long-term investment, but less conveniently for the investment industry, that the long-term return of the stock market was quite a lot higher than the average return of active mutual fund managers.
So Robin's book's an incredible, beautiful description of the history of the index fund revolution. As everybody knows, I love the book. And the University of Chicago is arguably the birthplace of modern portfolio theory, and we were so lucky last year to welcome Professor and Nobel laureate Eugene Fama to the podcast. Fama's career is an integral part of asset pricing models and market efficiency. So we asked Gene what it is like today to look back and see the impact of his academic work in the practice of asset management.
Well, it's kind of satisfying. So I don't take a lot of credit from that. I think my generation came along at a time when there was nothing in academia. Finance didn't exist, basically. So my generation basically opened the field up. And it was, great to be involved with all the people who did it. But we were kind of lucky in the sense that there hadn't been anything before that. So it was like fishing in a barrel, you just threw the line in and you always came up with a fish. The current people coming into finance have a big body of stuff they have to master before they can actually think about doing research in the area. So they're a little bit hogtied relative to what we were in the old days. Of course, the downside of that is we're now all old.
So when you were fishing in that barrel, did you know what a big deal this was going to become? Like, did you have a sense?
No, I'm absolutely not.
Really?
Yeah, absolutely not. Look, we were young people trying to do academic research that would eventually get us tenure, So we didn't really know where this would go. Plus, as Mike Jensen always said, I'm amazed that people pay us to do stuff we would do anyway. so talking about academic research. And that's basically true. I mean, the people who do it basically love to do it. It isn't really a job.
So did you see at all the evolution of indexing and Vanguard and the book Trillions by Robin Wigglesworth? Like, did you foresee this at all back then?
Well, in my view, that all took too long. That the evidence was there in the early 60s that this was the way to go. And it took a long time before that had a big impact. When Ken French did his presidential address for the American Finance Association, basically in that whatever was 50 years period since the beginning of this research in the early 60s, late 50s, the world had gone from 0% passive to, I think it was 20% passive at that point. And now it's up to 50, but it's still far from 100. So I don't know. To me, that seems slow.
Professor Fama's perspectives on that are just, I mean, it's incredible to hear him talk about it. In episode 216, Gus Sauter, the former CIO of Vanguard, joined us for an episode. He is a member of the University of Chicago alumni, and we asked him about the role that the University of Chicago played in the index fund revolution. And we linked that, of course, speaking with Gus, to the incredible success that Vanguard has had.
It all started in academia. The concept started in academia back in the 1960s, and it pretty much developed at the University of Chicago. Some of the big names in finance, Eugene Fama, Fisher Black, Myron Scholes, a number, Jim Laurie, a lot of people were right there at the University of Chicago, and they were known as the Chicago Gang, I think. And they developed the concept in the late 60s and actually implemented it. I think it was an assistant professor's father was the CEO of Samsonite Luggage, an assistant professor at the University of Chicago. His father was the CEO of Samsonite, and their pension fund had been underperforming for many years. And so he convinced his father, why don't you just invest it in an index fund? And so that was the very first index portfolio was Samsonite Luggage. And again, it was the assistant professor at U Chicago who said, there's been a lot of great work, a lot of thought going into this. Why don't you give it a try? And from there, it took off.
Was there a distinct point that Vanguard realized that indexing was going to be huge?
I do remember about 1992 or 93, our indexing, as I mentioned, started at about $1 billion, then went down to 700 million with the crash of 87. By about 1993, 92 or 93, I think we were maybe up to 2 or 3 billion. So, it was growing, but growing slowly. And I remember Jack Bogle showing up in my office door saying, Gus, you wait and see. Indexing is going to be a big thing. We're going to get $10 billion someday. And I remember thinking, wow, $10 billion. That'd be amazing. And of course, nowadays, that's about 2 weeks cash flow for Vanguard alone. So, but that was kind of like the first time I heard Jack express that it would be a big thing. And I thought, $10 billion, that's just unbelievable.
$10 billion is simply unbelievable. It's such an incredible story how this all took off. So now let's bounce back to Professor Fama with some rapid fire questions. And we kind of go back to basics, and we asked him what it means for a market to be efficient.
Well, a simple statement is that prices reflect all available information.
That's a pretty good definition from the guy who maybe defined the term. To follow up on that, we asked Professor Fama what the implications are for investors if markets are indeed efficient.
Well, you can't expect that activities like picking stocks are actually going to generate superior returns for you. So you get the risk-adjusted return appropriate to the risk level that you take with your portfolio, but you can't expect more. So that's another way to phrase the efficient markets hypothesis. So your risk-adjusted returns are basically, expected returns are basically zero.
So the obvious next question for Professor Fama is, what are the empirical tests that support market efficiency? So here's his response.
So the best, I'll warn you in the beginning. I chuckle when there's bad news. So if you hear chuckling, bad news is coming. So the strongest evidence from your perspective is that if I look at managed portfolios, actively managed portfolios, what I find basically is the distribution of returns around zero. For excess returns are kind of normally distributed around zero before fees and expenses. After fees and expenses, it's a big negative sum game for those who go into that active management game. So the distribution of outcomes looks a lot like what you'd expect by chance if there were no ability to pick investments that have above normal risk-adjusted returns.
One of the questions that we hear a lot, and we've covered this topic in some of our own content this year too, is if all of the money flowing into passive index funds, or maybe just index funds is a better term, pose any challenges for market efficiency. So of course we had to ask that question to Professor Fama as well.
Well, you can't have 100% of the money going into passive funds, because then there's nobody there to, trade to make the market efficient. So the people who actually have information that other people don't have, you want them to stay in the market and use that information. So the real question that nobody's ever answered is, how many of those people are there out there? How many does it take to make the market efficient? Mm-hmm. So most of the trading by these investors just offsets the dumb things that other active managers do. So active management doesn't always make the market more efficient. Sometimes it makes it less efficient because people make bad bets. So the informed people have to offset these uninformed people who make the bad bets. So it takes more informed to offset the uninformed. The more uninformed there are.
So the index fund revolution that we've been talking about is largely focused, I think it's fair to say, Ben, on market cap weighted strategies. And as listeners know, we use the tools often from dimensional fund advisors in building our clients' portfolios. And these are different from a market cap strategy. So we asked Gerard O'Reilly, the CIO and co-CEO of Dimensional Funds, to articulate the difference to us, as most people are very familiar with market cap weighted strategies. So explain to us the difference between what Dimensional does and what market cap weighted strategies are.
This is why I kind of stumbled on index and passive. Those words always get thrown around, but what do those definitions actually mean? What is an index fund? What is a passive fund? You can argue nothing is truly passive. Anyway, technically, Dimensional is set up as active funds because they make decisions and implement in a way that is different from a passive market index. Anyway, it's interesting and important to hear Gerard O'Reilly explain this.
Yeah, I think that you're right. Most investors are familiar with the index approach. And I'll take you back about 40 years, 1981, when Dimensional first began. And David's idea was, could you have a rules-based, broadly diversified, small cap strategy that would appeal to institutional investors? And at that time, there were no small cap indexes on which to base the strategy. And so he basically started with a blank sheet of paper. And when you think about a small cap index, especially in the 80s, and you were going to be as rigid as an index, kind of the consensus was you would get killed by trading costs and you wouldn't be able to make money because the trading costs would be so high. So when you start with a blank sheet of paper, really you're not going to end with an index approach. You're going to end with something that is looking every day, implementing the rules on a daily basis, has some flexibility, is going to not have to buy every stock every day or weight every stock perfectly relative to its weight in the market, but get that broad exposure. And that's what started it all. And then you go through time and academic research came out to identify areas of the market that offer higher returns, like small caps, like value, like profitability, momentum, and so on and so forth. And so if you fast forward 40 years from that kind of beginning, some of those essence from the beginning are still in play today. And the way I describe what we do is, first off, we start with what is it that the clients are looking for? And then how do we deliver rules-based, higher expected return strategies to meet those needs? And a few things that are important there. One is rules-based. We think that we work with mainly financial professionals, so intermediaries. We don't work with the end investor. We work with intermediaries. On a rules-based approach, it's very good to work with intermediaries, largely because we can communicate, here's what to expect, and then you can monitor, you got what you thought you were getting, right? So we think that that's a good approach. But it has to have the right support, the right innovation, the right pricing, and we can get into all of that in the webinar. The other two things, though, that I think are important to what we do and articulate our approach is, one, market prices are predictions of the future. And you got to know how to use that information to manage risk and increase expected returns. But that leads you away from having a broad-based market index. And number two, optionality has value. You got to be able to capture it for your clients. And that also leads you away from wanting a rigid index-based approach. So the way I think about what we've done over time is kind of sensible ideas well implemented is how we often describe it. And it has a lot of the benefits of what you mentioned, these index-based approaches, but it doesn't suffer from the drawbacks. So the benefits are transparency, low cost, you know what you're getting. The drawbacks are lack of flexibility, rigidity. You're not reacting to the latest research. You're not building your rules for every type of market environment. And so those types of drawbacks we've left behind. So bring the benefits, but leave the drawbacks behind. And then you start to deviate from those market cap weightings to improve returns and manage risk. And I think that you end up with a good solution for investors.
Gerard is an incredible communicator, obviously, as you just heard, and he makes very compelling arguments for moving your portfolio away from market cap weighted indexing into some factor tilting. One of, I think, the most interesting and eye-opening interviews, at least from a theoretical perspective for me this year, was with McGill's Sebastien Betermier. And this episode has been discussed extensively in the Roush Reminder community, and it keeps coming up again and again. This was back in episode 196. Professor Betermier shared with us his research from his paper, from multiple papers. But this one's talking about who are the value and growth investors. And it just helps you think about, and we gave this a lot of coverage later in the year too, who theoretically, well, in this case empirically, who should be and who is investing in value and who's investing in growth and why. And I think that's a very important question to think about.
He added a lot to our knowledge this year. That was a great conversation.
Oh, when you take like the John Cochrane episode that we did and you build on that with the Betermier episode that we did, and it's all this, the ICAPM, the multi-factor asset pricing.
Yep.
How do you fit into the world? How are you different from average? And of course, in the first episode of 2023 with Professor Merton, we get a whole bunch more insight on this. But yeah, I agree, Cameron. This episode with Professor Betermier for me personally, it was a big one.
So, as the title suggests, and as you said, we looked at which types of investors tilt toward value stocks and which types of investors tilt toward growth stocks. And the purpose was to understand more the literature around the value premium and the value premium puzzle, which has been a key topic in finance for many years. What we do find is very significant evidence, again, looking at very detailed Scandinavian data. And in that particular data set, we are looking at the entire population and not just at their level of risky share in their portfolio, but their exact holdings in every single stock and every single mutual fund. And so we construct for each household a tilt to the value factor, right? So how exposed their portfolio is to the value factor. And then we identify, well, which of these households tend to have the strongest tilt toward value and which of the households tend to have the strongest tilt toward growth on the other side. And in generally speaking, what we find is individuals with a value tilt, they tend to be older, they tend to be wealthier, they're less exposed to the macroeconomy through their labor income, and they're more likely to be female, and they tend to have stronger balance sheets.
Fascinating. And how do these value tilts change over time, or do they change over time?
So we observe a very particular pattern over time. When investors are young, they tend to tilt their portfolios toward growth stocks. And then as they age, slowly but surely, what we will find is they migrate toward value stocks. We say they climb what we call the value ladder. And the climb is steep. Over the full life cycle, they climb approximately the equivalent of half the value premium that we observe in the data. So that's a big change in the tilt from about age 25, 30 all the way to age 65, 70.
So Professor Betermier talks about the value ladder and how people migrate toward value stocks as they age. Now, an obvious and important question is why? And again, to come back to something that was discussed extensively in the Rafterminder community in 2022, one of the big ones was this question. Okay, we observe this in the data, fine. But maybe that's because young people buy exciting growth stocks. Like it's the old behavioral versus rational explanation for differences in expected returns. Maybe young people buy growth stocks and then naturally migrate due to inertia toward value stocks as the exciting growth companies when they're young become value companies as they get older. So Professor Betermier gives us the full explanation of the value ladder. And interestingly, in the paper, I don't think in this clip though, he directly addresses that inertia concept and says that it does not explain the migration toward value stocks as people age.
We think it's a mix of effects. It's a strong result. And oftentimes when you have a strong results like that, you have multiple drivers coming out. What we'll find is that in general, age explains about 60% of the migration. Here, financial theory says that growth stocks, they may be risky in the short run, but they tend to be safer over the long run. So a lot of their risk comes from transitory price shocks, which you may not face as much over the long run. So they make more sense for younger folks with a long horizon, right? And so as they age, well, that benefit diminishes as the horizon gets closer. And so that can explain part of the shift toward the value tilt. Another driver is human capital. We believe that human capital explains about 20% of the migration. So that's 60, 20, we're 80% here. Here, financial theory says something else as well. It says that value stocks, in addition to the horizon effect we just talked, value stocks end up being more exposed to bad recessions. These are stocks with low market value relative to book. There's few growth options left in them. They tend to have more leverage. They tend to have more operating leverage, more fixed costs. So they have a harder time adjusting their production model during bad times. So they may be more exposed to default in times of bad recessions. And so when you're looking at the cross-section of individuals, you have younger folks, older folks. The younger folks have the bulk of their wealth invested in human capital, little financial wealth, whereas among retirees, it tends to be primarily financial wealth. And so the younger folks may want to hedge away from that risk. And part of that means, well, not tilt as much toward these stocks as some of the other investors. And then the third driver, which we believe explains about 20% of the migration. So we're at 60, 20, 20, we're at 100 now. So the remaining 20% is the strength of your balance sheet. Again, going back to the concept of the composition of wealth, when you're young, we find that the bulk of your wealth is in your human capital. It's in real estate, but it's very levered at that point, right? So you have some financial wealth, but your cushion is fairly small. There's also a lot of liabilities. There's the mortgage. You may have liabilities through your kids and other types of student loans that might remain. Whereas when you're more mature, you tend to have accumulated more financial wealth, and you don't have as much liabilities. By the time you're 60, 65, typically the mortgage is being paid, right? And so these individuals have more bandwidth to take some of those risks, and they're not as exposed to those bad recessions as the younger folks. And so again, it makes sense to tilt toward value if you have a stronger balance sheet and you can afford to bear these shocks.
So now we have some insights into who buys value and growth stocks and some of the reason why. And in episode 228, we had Eduardo Repetto, who's the CIO of Avantis Investors, join us. And we pushed this line of questioning with Eduardo and asked, what type of investor, if anyone, does a portfolio that's made up of 100% small cap value stocks make sense for?
He gives a great answer, and it's also kind of funny because he refers to we were part of an article about ETFs where you have to do a desert island pick.
Yep.
And you have to pick, if you were stuck on a desert island for whatever 50 years, what's the one holding that you would have? And I think each of us picked the U.S. or developed small cap value funds from Avantis for that for the desert island pick. So Eduardo refers to that, but he basically says it takes someone very special. Anyway, I'll let you hear it from Eduardo.
I think you answered that one, or one of you answered that to a journalist in Canada, because a journalist in Canada told me, if you go to an island for 50 years, one of you answered, take one portfolio. I know which one you say. I think the Avantis small value strategy. I don't know who of you, but look, it's if you, let's go back to Markowitz, no? And I think that there is an interview that has a beautiful phrase. I will paraphrase. I wouldn't say his right words. I'm saying, look, when he was thinking about the mean variance optimization, he was saying, hey, it cannot be that people pick when people create portfolio. It cannot be that people pick the highest expected return security, because if you are trying to pick the highest expected return security, you are maximizing return, just returns, but risk is not part of the equation. So you have to consider returns and risk together. That's what what guide Markowitz to create the means variance optimization, or the risk return trade-off, if you want to think about that. And so in general, I would think that most investors will be happy to have a small value, but as part of the portfolio, overweighted probably because they want to enhance expected returns. But having it in isolation will be someone very special. So someone that only buys small value will be someone very special, like you guys, if you go to an island for, I don't know for how long you mentioned. And so who will be that someone very special? It probably will be someone that has excess capital, so money that they don't need really, a lot of excess capital, that have very long investment horizon with very long-term asset growth objectives. And for someone like that, probably it make sense. But most of us humans that are not in that situation, we probably have a portfolio that is a little bit more diversified than just a small value.
Good answer.
Yeah, it's such an interesting one, because small value might be more volatile. But when you look at, again, empirical data, like what outcome is more reliable, small value actually starts to look pretty good. So it's a tricky one to think about.
Yeah, remember, diversification matters. And that's, we learned that from Markowitz, and Markowitz learned by observing how people behave and then put it in a mathematical model that is a risk return trade-off. But certainly there may be some investor that's the right portfolio, but most people will have something that is more diversified than just small.
But it goes back to your comment about trust. You really have to trust in this premium,
right?
Yeah, to hang on that long.
You feel better. You feel better if you think that that's related to valuation. It's not a pattern, and so that's why when you look at companies holistically instead of just picking a factor, like for example, if you pick a low price to book security, a low price to security can be a security that has low price because they really have no earnings, for example. And you say have low price because of no earnings. It's not because they have a high discount rate. The price is low because no earnings. I call them like a gas station sushi. The price is low, man. We want cheap sushi. Let's go to the gas station. Well, I don't know if that's the right thing. I prefer to go to a sushi place like the one they have across the street. You guys should visit. It's an old Japanese guy, 10 seats, and they have great prices, to be fair, and the quality is amazing. So, well, I prefer companies that the discount rate is high. The price is low, not because the company doesn't have earnings, not because the company is full of liabilities. I prefer a company that the price is low because the price is embedded in a big discount rate. And because that discount rate is my expected returns. Low price for the sake of low price doesn't tell you much.
So that, Ben, is possibly the clickbait quote from 2022, which I know has been picked up by a lot of listeners. Gas station sushi. Don't buy cheap just for the sake of being cheap, which is a good point.
Yeah, it was a great point. Don't buy gas station sushi. It's cheap for a reason.
Cheap for a reason.
Now, continuing on this concept of, we've talked about the growth of index funds. We talked to Professor Fama a little bit about the implications for market efficiency. and whether we're going to reach an index fund tipping point and that kind of concept, which again, that's something that we gave within our content quite a bit of coverage to. One of the most insightful parts of our conversation with Ralph Koijen addressed this directly. We asked Ralph, because he's looked at the numbers, he's done the research, he's got the model to look at it. So we asked him just straight up, are our index funds distorting market prices and making markets less efficient?
So it's not obvious. So it's not very obvious to me. Like in the sense that in terms of like an impact on elasticity, I think there's some evidence that they may have. In terms of like directly distorting prices and making markets like less efficient or something like that. From what I know, I think there's at least from our calculations, that's not something that we see. If you look at sort of like going back to what we talked about before, if you look at sort of like where the money came from that went to passive investors, and see whether it came from investors who are systematically more or less informed about future fundamentals, that correlation is like essentially zero. And so it's not that systematically, like it went sort of like similarly from like informed and uninformed investors to more passive institutions. And so given the absence of that correlation, at this point, I don't think there's much evidence that I'm aware of, at least. Like maybe there's other evidence, I don't know, but based on that calculation, it's not that obvious to me.
So another interesting pair of guests this year were Professors Jonathan Berk and Jules Van Binsbergen. They're highly engaged, a little bit spicy, which certainly made them really interesting. Not to mention their engagement was super engaging, super fun conversations. And their research shows that skilled fund managers can add value. So we pose them the questions of whether it is possible to identify these skilled fund managers before the benefits of their skill are absorbed by the size of their fund.
Their whole thing is that maybe the capital markets are a little bit less efficient than we thought, and therefore managers are able to demonstrate skill. You just have to know how to measure it properly, which, of course, they're saying in their research they're doing. But then they're also saying that the market for manager skill is highly efficient. Now, if the capital market is a little bit less efficient than we thought, but the market for manager skill is highly efficient, what do we expect to see? Anytime that the market identifies a skilled manager, they're going to reward that manager with capital up until the point, like you said, Cameron, the manager's skill, the benefits of the manager's skill to the end investors are absorbed by the size of their fund. What does that mean? It means that the alpha decreases with the scale of the fund. The fund grows larger, the net alpha to investors gets smaller. In equilibrium, the net alpha is zero, and investors earn a return commensurate with the risk that they're taking. So this came up in discussions a lot after their episode. This doesn't mean you can pick active managers unless you can identify their skill before the market does, just like picking a winning stock. Same kind of idea. And then the other piece of that is that it doesn't mean that funds that seek multiple price risks like Dimensional or Avantis or whatever other fund is trying to do that, it doesn't mean that they're not able to have higher expected returns if you believe that there are systematic premiums within those funds. Now, that was a whole other interesting part of the conversation with Professors Berk and Van Binsbergen. They talked about CAPM being the only price risk, but that's a whole other thing. If you believe that there are multiple priced risks out there, then you don't care if the net alpha is zero. That's what you want. You want the risk premiums. You're not expecting an alpha. You're expecting compensation for the risk that you're taking.
Well, I gave you an example of that, right? So if it's the case that you think people are making a mistake, and so if a foreign sounding name means that people are not on the ball, and therefore they're too slow in the capital allocation, as just as much as if you think that the information about Apple that just came out is not properly incorporated by the market in the price because they're making a mistake and there's a good reason to believe they make a mistake, you can bet on that. if you think that there's a mistake made in the capital allocation process, and there are reasons for why people are irrational in the decision-making process, yeah, then you could try to exploit that. But it does have to be something where you know that the market, you know something better than the market, either because the market is making a mistake or because you know something before they do, just as it is with stocks. Now, that said, we do see that the flow performance relationship, which is this equilibrating mechanism, it is not as fast as with stock markets. Right, so it is with stock markets or with bond markets. I think within an hour or 90 minutes, generally we see prices quickly converge to the new equilibrium level that they have. So with the flows of the mutual funds, there are some frictions there that make it that can sometimes take a little longer for the flows to happen. They still happen. But I think the flow performance relationship peaks after 6 months or something, 3 to 6 months. So the little bit of evidence that we do have on alpha predictability is therefore at the very short horizon, but it very quickly mean reverts and disappears.
Yeah,
right?
so if you're willing to, if you're willing to move your money every 3 months, there is evidence that you could exploit the fact that the flow performance relationship is slower. But that said, if you have inside information, then of course you can make, I don't mean inside information as illegal inside information, as privileged information, then of course you can make money because there are lots of managers that have too little money to manage relative to their true ability. But the point is, it's very hard for individual investors to have information. It's not hard for the mutual fund companies. I mean, that's the point of our other paper. The mutual fund companies know who the good managers are, and they move the capital.
Okay, I've got a question. So we had Gus Sauter, who was the former CIO at Vanguard for many years, and so he made this comment to us. He said that because of his position at the company, he felt that he did know that there were some active managers that he could allocate to, and he believes in active management, and that sounds like it perfectly aligns with what you guys are talking about.
Exactly what we found.
Wow.
Exactly what we found.
Very
it is interesting. Jules and I are academics, and it's very interesting as an academic to then talk to practitioners about what they themselves are doing. One of the things you may say to me is, well, don't the practitioners already understand what they're doing? And they do in their own world. But generally, practitioners have never taken a step back and thought about how they fit into the big picture. And that's where, when you have discussions with them, they suddenly begin to see where you're coming from in the big picture. And, it's an interesting process.
That was a pretty fascinating conversation, which is very much like our next highlight, which is from Professor Scott Cederburg. Also, great guy, great conversation. And we asked Scott about data sets being upwardly biased due to a number of reasons, which he explains, and why it's important to be aware of this inherent bias when looking at data.
You think back to the earlier clips that we listened to, and the index fund revolution is in many ways synonymous with like an S&P 500 index fund. And I think that's what a lot of people think about when they think about index investing in general.
Yep.
But one of the problems, and we've talked about this extensively in not just in 2022, but throughout the podcast's history, the problems with the sample bias in the U.S. and the survivor bias in the U.S. data. And Scott's done this incredible research, building what you referred to when we talked to Scott Cameron as this sort of archaeological dig data set, where they're going through historical records and resources that people have not previously used to build extremely accurate data sets that take into account gaps in the data, like in those gaps, what happened, and countries that usually get omitted when that country's financial market went away, what happened. And so those become really important additional data points when you're thinking about what are the expected returns of stocks? What have the historical returns of stocks been? That's not something that we really know. And well, until Professor Cederburg and his team started pulling that data together.
That's what we've found. So we've done a couple of where we sort of purposefully put back some bias into something. So if we just condition on like which countries are currently in the OECD, that has some effect on our estimates. And then even more importantly is if we like dropped everything that was a gap period in the data or before. I forget what the exact numbers were, but it roughly cut the probability of loss in half. Wow. If you like introduced this bias back into the data.
Why do you think having data like yours that corrects for the easy data bias and the survivor bias, why do you think that's important for financial decision making?
Yeah, I think it's really important for like any sort of forward-looking thing. I mean, in one sense, we're obviously looking backwards and we're looking at all these historical periods. But when I'm thinking about this stuff, I'm always trying to think about, the reason that we got into this in the first place is like very practical. It's like, what could happen to my investments over the next 30 years? And so like the focus that we've been doing it with most so far is like distributions of returns at a long horizon, like a 30-year sort of horizon. And so if I'm sitting here in 2022 and I'm thinking about what's going to happen to me over the next 30 years, we've seen just a lot of paths that countries and markets have taken historically that I don't think would have been anticipated at the beginning of those periods. So I think just trying to get as much of an ex ante view of the world as possible is helpful.
All right. Now, one of the contributors to long-term economic growth is innovation. I think that's pretty widely accepted. We talked to Bill Janeway about how the mission-driven state programs, like the government investing in stuff that they think is important, that they have a mission toward, and financial speculation, how those things occasionally come together to fund transformational technologies. This conversation was particularly interesting because throughout 2022, in the last few years, really, there's been lots of talk about transformational technologies and whether whatever technology we may be talking about in the moment is indeed transformational, one question, and whether there are outsized expected returns for investors in that technology, second question. So we had a great conversation about with Bill about that, and here's one piece of that.
So we asked him to describe what is the three-player game, which is exactly what you're describing here.
I began to recognize long ago the impact of technological innovation on the markets of the economy, the places where people work and buy and sell and spend and invest. But a question in the literature on the history of technological innovation did not address a really basic question. Where does the money come from to fund innovation at the frontier when by construction, no one can know what the consequences are going to be? And that led me to two deep histories. On the one hand, the role of government, the role of the state in making investments for reasons that are not immediately concerned with economic return, that are for national security, national development, like subsidizing the American railroads during and after the American Civil War. And then recognizing, and this of course really was the case in the late 1990s, the successive waves of financial speculation that have animated all markets where assets of any kind trade, from tulip bulbs in Amsterdam in the 1630s on to cryptocurrencies today. But occasionally we can look back and see that the speculation has focused on assets which, when deployed at large scale, have a transformational impact on the economy. The railroads, electrification, the internet are the obvious standout cases. So my notion of the three-player game is this interaction, this interaction that never finds an equilibrium. It's like the three-body problem in physics, between mission-driven state programs, financial speculation that occasionally come together to fund the development and deployment of transformational technologies. That's what I call the three-player game.
So up next is Oxford's Professor Phalippou. arguably been the global expert in studying the outcomes from private equity. So private equity is an extremely popular asset class and one that we are asked about often. And there's so many challenges. I mean, one of my big takeaways was the challenges in measuring performance. And so we wondered, obviously, if the performance meets up with all the hype that's around this. And that's exactly what we asked Professor Phalippou when he was on, about the comparison of private equity performance relative to public equities.
It kind of comes back to what we were talking about with Scott Cederburg. Like, if you have historical data that's wrong, you may very well draw incorrect conclusions. And I think we heard something somewhat similar from Professor Phalippou that, well, here's how you should be looking at the data, and here's what you see when you do.
A caveat first is that this is the past, and it's more important to think about the future. But it's good to have an idea of the past. But we should certainly not make investment decisions based on past returns. We know there is no relationship, but people keep on just being very obsessed with past and track records. So, in a nutshell, private equity in Europe has done much better than public equity in Europe, but the industry mix is completely different. So if I just tell you that public equity in Europe is banks, oil and gas, and things like that, and tell you they underperformed a portfolio of tech firms in Europe over the last 15 years, shouldn't come as a surprise, right? So we don't know if industry corrected, that would be different. Emerging markets about equal anyway, even the way it is. In the US, there is this complexity with a large cap that did very badly from 98 to 2008 and did normally after. So what happens in the US is that if you would take an index which is not including like the largest market caps, so anything like the S&P 400, S&P 600, or some other indices, or you take like a dimensional fund advisor returns, things like that, or the CRISP, the Chicago indices, you would find that private equity was very close to public equity over any time period. The problem is when you use the S&P 500, you have this so to give you an idea, like over the last 100 years in the US, if you take any size categories and you calculate their 10 years returns and you just roll it, right? You start in 1920 and you say, okay, 1920 to 1930, 1921 to 1931. You do this 10 years rolling for 100 years in the US. There is not a single category in these 10 size deciles that have ever had a decade with negative returns, except for one category in one decade. And it is the largest cap, the top 10%, from 98 to 2008. That's the only one. So it means that an index like the S&P 500 has an extremely low performance from 98 to 2008. So up until 2008, whenever you would see an investment presentation, it would be benchmarked against the S&P 500 because it was like trivial to beat the S&P 500. So people keep on playing with that. So when they show you the last 10 years of performance in private equity in the US, I will never show it to you against the S&P 500 because it's going to be close to 1-to-1. When they bring in the S&P 500, it's going to be the past 20 or 30 years because then it's going to include the 98 to 2008 time period. If they're going to show you a recent period, they're going to use MSCI World because it's the worst performing index over the last 10 or 15 years. But if throughout someone would have used a stable index like S&P 400 or something like that, you would have seen that any horizon, it would be very close to the public equity in the US. And like I said, in the US, the mix is pretty similar. So it is a reasonable comparison. So it's not bad returns. And if private equity has been a bit diversifying, net of all fees, if you get about the same as public equity, it actually hasn't been a bad deal. It's not the amazing deal that the consultants are selling to you, but it hasn't been a bad deal. Now, going forward, one has to think about whether a high fee in a low interest rate environment is a good idea, right? So if you're going to have lower expected returns, even if private equity outperforms public markets growth of fees, and they do, you have a very high fee structure. And so in a compressed return environment, how does that work, right? So usually it's not very good news. So that's why I encourage people to think more from fundamentals about the future rather than just looking at the track record saying wasn't bad in the past, so it's cool. But it's still important to know that in the past is not as rosy as what consultants tell you.
One of the consistent pitches, other than higher returns for private equity, is the idea that it is a diversifying asset class relative to public equities. If you add private equity to your portfolio, you're going to get some more diversification than you could get just by owning public stocks. Now, I think a lot of that pitch is often related to the smoothing in private equity returns, but we actually got a much more nuanced answer from Professor Phalippou that I really appreciated.
It's reasonable to think so. The question is to which extent. And then is when you need to do a bit more homework, that some private equity funds, one can see intuitively for diversification. But if you see some private equity firms investing in something like Hilton Hotels, and you have a Marriott that is publicly listed, in terms of diversification, I'm not sure, but it helps me to buy into Hilton on the private equity side when I can have Marriott on the public equity side. So it depends on the strategy. So usually overall, if the larger a fund is, the more they invest in mainstream type of companies. And so the more similar they are to publicly traded ones. So if you want to look for diversification, you would tend to go towards more niche fund, and most by construction, right? Somebody doing software in Europe. I guess there's no such thing that are publicly listed. So yes, that would be diversifying. I don't know if it's a good return or not, but that would be diversifying.
The demand for private equity, as you said, is about diversification. And we continually hear that 60-40 is dead, for example. I mean, you hear that, I know my Twitter feeds got lots of comments like that. There's also many investors concerned about volatility this year. So we welcomed Antti Illmanen, who is the co-head of Portfolio Solutions Group at AQR, to join us. And he was on episode 202. And we asked him, what are some of the things that investors can do to stick with investment strategies during periods of poor performance?
So in the background, there is this issue of, investor impatience. Investors require more consistent performance than is feasible in competitive markets. And this is again, even with equities, but certainly with anything less conventional, that we get even more this problem. Can be a factor, can be a manager, can be anything. And we know that we need very long data to truly distinguish luck from skill or whether a factor is positively rewarded. But few investors have the patience for this. But strategy is good only if you can stick with it. And in that spirit, I emphasize the importance of identifying the strategies that are consistent with your beliefs and that you can then stick with. And for many, that answer may be that, okay, really, let's let equity conventional risk dominate. By the way, it sounded like it's a binary choice. Then I think one can do some of these other interesting things, but size them modestly so that you don't then capitulate too quickly. But what I also do in the book is I suspect that most investors look in the mirror and like to see their patient long horizon investor, and I try to then cultivate that patience. And so I give some ideas. So I think being educated about both the empirical evidence and theoretical rationales for anything, they can help sustain patience in bad times. And I suggest some practical tips, such as viewing your portfolio broadly and rarely. So broadly means that you don't fall to the line item thinking or try to reduce the line item thinking type of things. And there are tricks for that. Look at return contributions as opposed to, that's return of the asset times portfolio weight, which is a smaller number. That can be helpful. Or when you look at performance over time, you have to probably tell last quarter's performance, but put it last as opposed to the first in the list. Start with some long horizon estimate. So it's and again, this doesn't have to be, this shouldn't be done without explaining this to let's say a client. That the client should know that we are doing this together so that we are cultivating better long run behavior, and then I think it makes all the sense in the world.
Great advice from Antti. Now, what's an alternative strategy? One of the things that you can do is not look at your portfolio. It's kind of like the smoothing effect in returns that I mentioned earlier. If you just don't look at it, you won't be worried about the the returns. So in this clip, we talked to Professor John List from the University of Chicago, author of the book, the most recent book, The Voltage Effect. Professor List has research that answers this question exactly. How often should people look at their investment portfolio?
As rarely as possible. So what we find in our research, and it was really taking some of the earlier work from Dick Thaler and colleagues, as well as Uri Ganizi and Jan Potters, and we took it to the field. And we explored, first of all, our students and our professional traders. Do they have what's called myopic loss aversion? Do they have both myopia and are they loss averse? When I say loss averse, I mean you treat losses as much more important than comparable gains. So we took that to the traders, and what we find is, yes, indeed, those traders as well as the students, because a lot of times people say, well, that's a lab result with students. The real traders won't have it. Well, I took that to task. And what happens is the real traders have it and then some. Wow. They're myopically loss averse. So what does that mean now for everyday investors like me and others? It means don't look at your portfolio. You know, if you need to, I totally get it. But I would say once every 3-6 months is fine. But the reason why I don't want you to look at your portfolio is because when you do, and you see losses, even though they're paper losses, you say, my gosh, that hurts. And you're more likely to move your portfolio out of risky assets and into less risky assets. And as we all know, just look at the data. The data over long periods of time, that's the equity premium puzzle, is that you get much higher returns if you're willing to bear some of that risk. Now, if you look at the account a lot and you have myopic loss aversion, you'll be much less likely to bear that risk. So you'll move out and you'll be in inferior investments. So the implication is don't look often, and as rarely as you can, take a look. It's always good to take a look, but don't punish yourself.
So part of what I got from Professor List's comments is that emotions can really play a big part of your behavior, which of course bad behavior can lead to, less than great returns. This is always a rational mindset. We're taught on the rational reminder. And one of the big lessons I got this year was from our longtime friend and theoretical physicist, Leonard Mlodinow, who explained to us how the rational mind and the emotional mind are actually quite intertwined. It's a bit of a mind-blowing conversation to me. This is back in episode 190, early in the year. And we asked him the question, are emotions detrimental to decision-making?
Yeah, this was a mind-blowing conversation. Basically, there is no such thing as an unemotional decision, whether you like it or not. There's no such thing as a rational thought.
I think we both did a double take with that, and he's right.
Well, that's one of the big revelations of the last 10, 20 years, is that's definitely not true. That's been the idea all the way back to Plato with his chariot, and the idea that you had certain drives, passions that had to be taken, put under control by your rational mind. In the modern world, in modern science, it was Darwin who really created the modern theory of emotion, scientific theory of emotion. And Darwin wanted to know why we have emotions with respect to his theory of evolution. Why did they evolve? What role do they play? And he studied cultures all over the world, and also all sorts of other animals, mammals, to understand what kind of emotional experiences they have. And he concluded that emotions play a role in the animal world, mainly of communication. So that if one member of a species approaches or attacks another, and that one looks angry, that the first one might back off. Or if there's a predator in sight and one looks scared, the other ones would notice that, and they would all take action. And since humans have language, and since we have rational processing, Darwin concluded that this was outmoded. It was a vestige like the appendix, and we really didn't need it. And that when emotions played a role, they would interfere with our rational processing, and they were a lower kind of processing. Well, now we know that that's all wrong, that first of all, as I said, your brain is a processor, but it cannot work in a vacuum. Like all computers, it needs to know what questions it has to answer. It needs to know what data to consider and how to value that data, et cetera. And all this is governed by your emotions. So without emotions, first of all, without emotions, you wouldn't even get off the chair, because what motivates you to do things if not feelings? So emotions are not just productive and a useful part of our processing. They're inseparable. There's no such separate thing as an emotional mind and a rational mind. Those two minds work together always.
So these two minds work together, and they really are inseparable. And to me, this links nicely, Ben, with goal setting, for example. You need to have an emotional attachment to the goal, and that attachment will motivate you to seek out rational ways to achieve that goal. So a common goal that a lot of people have is to add value, to improve the world. And in episode 192, we spoke to Professor Alex Edmans, author of the book Grow the Pie, and we asked him how people in everyday life can use grow the pie mentality to make the world a better place.
I'm really glad that you asked about people, Ben, because often people ask me this about companies. And with companies, unless you're the CEO, you don't really control the company. So pie economics might be irrelevant for the ordinary person working in an organization. So what is the heart of pie economics? It is how to create value. And why I think that's so powerful is that anybody can create value, even if you're the most junior person in an organization. So one thing that I encourage people to ask themselves is, what is in my hand? What do I have in my hand? It could be my resources, my expertise, my time, and how can I use this to benefit other people? So as an example, my first job was at Morgan Stanley in investment banking. I was right at the bottom, right? I thought nobody works for me. There's nothing in my hand. I have no influence. But in fact, what I realized was that people did work for me. There was my secretary, there was the IT department, and there is perhaps the most abused department in an investment bank, which is the graphics department. So the graphics department, what you do is you scribble some slides, you give it to the graphics department, they come up with some PowerPoint. And often the analysts would shout at them for not doing what they wanted, even though it was the analyst's fault for not having explained it clearly. But there were times where I got some good work back from the graphics department, and I call them up and I say, hey, this is Alex. Somebody just did my job. I just wanted to say it was really good. All these three things I asked for were great. And this fourth thing, I didn't even ask for, but you did it anyway. So even as a junior person, in my hand, what I had was my words, my ability to say thank you. And honestly, I did not do this to be seen to be a goody-goody, to be seen to be a nice person. I did this honestly just to say thank you. But because I was so junior, because I was right at the bottom, I did not have my own office. Right? I sat in the bullpen, which is where all the analysts sit. And so other analysts heard me doing this, and they started to do it themselves. Now, I'm not going to claim I changed the entire culture of Morgan Stanley. Clearly, I did not. But certainly that 7th floor of the offices in Canary Wharf, London, people started to think, oh, yeah, can I say thank you to others? And so I'd say what level you might be in an organization, you can actually have a much greater influence than you think you might, because whatever you do might be noticed by others and has a catalytic effect. So similarly, in the pandemic, when some of my friends posted on Instagram or Facebook that they were helping doing shopping for elderly neighbors, and we could ourselves think, well, what can we do to help out? One of my friends who's a lawyer said, oh, he went to his local coffee shop and he advance purchased 100 coffees to give them £300 to give them a little liquidity injection. So all of these things are small things, but if you go with the mindset of how can I actively create value and have a positive impact, that's really different to how people typically approach sustainability. With sustainability, we think about how can we do less harm? How can we cut our carbon emissions and so on? And certainly that is something which is important. Can I sort of bike to work rather than taking an Uber? But I think what's often overlooked is the pie and growing idea of actively creating value through our words and our actions. And I think that is something that really can be unlocked.
In episode 208, we welcomed author Rebecca Walker. And one of my takeaways from that conversation was the importance of trying to understand one's money story. How is money discussed as you were growing up? How did your family actually handle money? Did you handle it well? Did you have enough? And each of us has a money history. And I do think it's important to try to understand yours. So we asked Rebecca, what effects do you think learning about money has on people's lives?
I think it's critical to learn about money. I think that, this book is really, people come to it and they say, oh, this is completely different than I thought it was going to be. They thought it was going to be a book about, how to invest, how to create a budget, how to, breaking down the stock market, savings bonds, and I say, well, this is actually the book that comes before you do that work. This is the book that really helps people to excavate their own stories about money, what they've learned about money, what they feel about money. Do they feel they deserve money? Do they feel guilty because they have too much money? Do they feel that they're just following a script for how to engage with money? Or do they feel that, in fact, they have an awareness of how they want to use money that makes them feel good, that makes them feel good. And that is, again, as I just said, in alignment with the higher vision. So I think that, so many people think about learning about money in this very specific kind of solely financially, pragmatically based way. It's these numbers, you're making this, you do this with it, da, da, da. And for me, learning about money is about learning about yourself. What do you care about? At the end of the day, when you die, you will be, you will have left a legacy, not just in how you've treated people, how you've loved, what you've created, what you've said, but how you have used your money, how you have transformed your labor, your mind, your intellectual capacity into something that can help and support the things you believe in. So in that way, I think that learning about money is really about learning about yourself, and knowing who you are first and foremost, so that you can act effectively and skillfully with money as an extension of yourself,
Colleen Ammerman, who's the Director of Race, Gender, and Equity Initiative at Harvard, joined us on episode 218. We wanted to learn more about gender inequality. So we posed to Colleen the question, how do you describe the current state for women in the workplace?
Call it kind of a stalled revolution, maybe is one way to think about it. So if we think back to, the past 50 or 60 years, an enormous amount of change has happened, right? So things like sex segregated classified ads, where you would literally open up a newspaper and see jobs for men and jobs for women used to be perfectly legal, right? So we're a long way from that. But if you look particularly at rates of women, proportion of women in leadership, really across kind of any industry or sector or field, that has not really budged since the 90s, right? So we have kind of been in a place where a lot of progress was made in kind of the latter half of the 20th century. And, we've continued to make progress since then, but still at a much slower pace. And kind of, we're certainly not at gender parity.
Interesting. So what are the quantifiable symptoms of gender inequality in the workplace? Like, in other words, how do you really know there is a problem?
Sure. Well, the one really easy way, right, is to just look at who's in leadership, right, who's in positions of power. And so that's really lots of kind of indices and metrics will tell you that. You look at, kind of sort of marquee things like CEOs, right? In the Fortune 500, S&P 500, FTSE, et cetera, women on corporate boards, right? Like we have these measures of who is in power in business and in corporate America. And women are still certainly a minority, and women of color an even smaller minority. But then there's also lots of other, quantitative ways that you can look at it, compensation, just rates of promotion. So there's lots of different ways that you can kind of think about how organizations value employees and kind of see ways in which women, I would argue, are not being equally valued in terms of their rewards.
One of the things that we spent a lot of time on this year, learning about ourselves and doing research on ourselves, which was kind of fun to do our own sort of somewhat primary research, was on goal setting. So we did the goal survey. We turned that into a goals master list that people can use. It's a white paper now on our website. We discussed that in episode 223 earlier in the year. And this was a big part of the Finding and Funding a Good Life paper that we did. Earlier in the year, we spoke with Ayelet Fishbach from the University of Chicago. She wrote the book, Get It Done. We asked her in episode 188 how important she thinks it is that the pursuit of the goal itself be enjoyable.
It is very important that the pursuit of the goal will be enjoyable, or somehow that it will feel good. Okay, sometimes it feels right, even if it's not enjoyment, and it's very important because we really discount anything that is in the future. Okay, now it's not that we should. Okay, we should not discount outcomes that are in the future, but we do because this is our human or our animal nature, and so it's just hard to do something that will benefit me in the future. We are so much oriented toward the present. I had a conversation with a colleague the other day, and we were just like in our minds thinking about like the kind of time commitments that we make. And basically, most of us would say, I'd rather give you an hour next week than 5 minutes today. What does that mean, right? Like, I can absolutely not afford 5 minutes today, but I'm very happy to commit 1 hour of my time next week because it's in the future. That's like we discount too much, okay, beyond what's good for us, and that just makes it harder. But if we add the immediate outcomes, if we make something pleasurable or feeling right at the moment, then we can do it for the sake of the moment. Let me also say something about feeling right, which is not necessarily enjoyable. We recently published a study about improvisation. We did it here with the Second City, which is the famous Chicago improvisation club. And we invited people who were just starting improvisation to feel discomfort while they're doing that. We actually told them, your goal is to feel uncomfortable while you engage with the exercise. Now, here's what that did. It was very easy to feel uncomfortable, okay? If you ever try to do improvisation, if you are not a professional, the first thing that you would feel is embarrassed, okay, and uncomfortable. And if that's your goal, then it feels right, okay? Like you're doing what you were supposed to do. You were asked to feel uncomfortable, and here you are feeling uncomfortable. And so by having people trying to feel uncomfortable, we got them to engage more, and they did more. They were more interested in doing improvisation again. They were excited about doing it. And so it's not really just about enjoying the present. It's about feeling that this is right, okay? That you are in the place that you wanted to be, that you're making progress.
That's a cool study.
Thanks.
So what about long-term retirement planning, where the goal is very far in the future in many cases, and progress, I mean, you're saving money. It's not fun. It doesn't necessarily feel good. How would you approach that situation?
One of the hardest goals. Okay?
Right.
Everything goes against you, right? Like it's hard to get excited about it. It will help a person that is very much in the future and not quite connected to me. It's highly extrinsic and despite that, very much necessary. And so, one thing that we find that works is making it into a habit, okay, or using a default, just getting it off your mind. If you had to decide every month or, even every year about your retirement saving, we know that people just don't do that, okay? They don't want to engage. So most of the interventions with retirement are really geared toward creating some plan that will just be automatic, will take care of that, giving people really good defaults. Okay, if you just don't make any decision, then your default is pretty good. These interventions are better than telling people every day when you get up in the morning, remember that you need to put some money aside for retirement.
So the idea that it's hard to set a goal for some distant person is so fascinating to me. And we all know, for example, we should save for retirement. However, that's not always terribly enjoyable to save for some future person in some future decade. So this really gets to the question of life satisfaction, which is something we talked about with personal finance author Andrew Hallam. His most recent book is called Balance, which talks a great deal about happiness and life satisfaction. So we asked him about his observation that life satisfaction increases after middle age and whether people can get to that satisfaction place sooner in life.
I think, Cameron, is difficult, but it's doable. And I think, too, one of the things about, when you get older, too, you recognize your own mortality and you start to realize what's really important. But I think that young people can recognize this stuff when they see the science behind life satisfaction. I think it can become a lot clearer to them when they see the science behind material acquisitions and hedonic adaptability, for example, and how pursuing things won't enhance your life satisfaction. That perhaps trying to keep up with the Joneses is a futile quest that doesn't enhance any kind of internal satisfaction long term. I think once people can see that, it's sort of like a lot of people tell me when I explain to them about cars. A lot of people, when they get their first job, they borrow a bunch of money and they buy a brand new car. And I know that when I started telling people about Thomas Stanley's research on what does the average millionaire drive? Did you know that, in 2019, the median price that for the most recent car in the United States purchased by millionaires was $35,000, and that most high-end cars are not driven by wealthy people. They're driven by people with high incomes, but also high debts. And it's been interesting over time because I've been a lot of younger people who've said to me, I remember that. I remember that. And now when I see somebody who's young, who's driving a super expensive car, I don't necessarily feel envy for them. I recognize that that person probably doesn't have or might not have a lot of money. That most people that drive super high-end cars, most of them don't. Some do, for sure, but most of them don't. And I think then back to your question, when you're looking at research on life satisfaction, although it's probably harder for younger people to be able to put that aside and decide they're going to be true to themselves at a younger age, they're not going to be as influenced by peer and social pressures. Although it's more difficult at a younger age, in your 20s, 30s, and early 40s. Is it doable? Absolutely. I think it is.
Always so good to hear from Andrew, and that was him back for his second appearance on the podcast. Another fascinating conversation that we had related to goals was with Jay Van Bavel. He wrote the book, The Power of Us. And one of the big takeaways from our conversation with him was the power of identifying yourself or a member of a group, which becomes a source of inspiration since you'll create goals relate to that identity. Could be for your career, your health, your social life, or for retirement, whatever. So we asked Jay in episode 214, what effect group identity, the group that you identify yourself as being a part of, has on goal setting.
That to me is so cool.
Oh,
It was honestly, it was a surprising interview. I loved it. But when you start applying how being part of a group can inspire you to set goals, like I'm an athlete, therefore I work out every day, as opposed, I got to go to the gym this morning. But just these identities, whether you're a parent, an athlete, a scholar, a reader, whatever your identity might be, has an impact on setting goals. It is so cool.
Yeah, so identity helps activate certain goals at the front of their mind. So I said, I'm an author. That's why you're interviewing me. That comes the moment I adopted that identity. I actually got included in different communities and conversations with other authors. They helped me out. The conversations we had were about those types of things. But also, man, I had a set of goals. I had to take responsibility for writing the book, editing it, making sure it wasn't going to be embarrassing. And then there's like a whole, year of promoting it, doing podcasts, op-eds, talks. And so those are a lot of things that I've never done before because I never had a book before that were focused on it. And so I had to achieve those goals to make sure that people could hear about the book, because a book's very much like that old philosophical saying, like if a tree falls in the forest and no one hears it, did it really fall or did it make a sound? Books are very much like that. It's a lot of effort for someone to buy it and then pick it up and read it. It's a major commitment. So you have to convince them why that's interesting. And so that activates the authorship of being an author, activates all those types of goals. and then you're hustling to try to achieve them. But as I said, I'm a father, you know, in the mornings when I wake up, my kids like need lunch, they need to be packed for camp. I need to help them with their homework. I need to make sure that they don't spend too much time on screen. When I'm thinking about myself through that lens, it has a whole bunch of goals that come to mind that are very different and that are immediately important. And so that's one of the ways identity affects goal pursuit. It activates different goals. So you want to think of adopting and reading into the right identity, because it will come with a set of goals and responsibilities and norms that you want to uphold. The other way that identities help with goals is that they can keep you on the right track. So this is one of the reasons why, you know, if you want to get in shape, it's good to have a gym buddy, because you start to you can easily avoid going to the gym if it's just you, you know, you're not feeling it that day, you don't want to exercise. But if you have a buddy there, they're going to hold you accountable for that. You got to show up each day and they're going to push you to do that extra rep. And that's what groups do, identities do. They uphold you to the norms of the group. And so if you're part of a group, you know, I'm a professor. And so one set of responsibilities I have is to like publish scientific articles and do research. If I don't do that, I would not have gotten tenure. I would have lost my job, or I would not get a pay raise. Or if I write an article and it's really bad, I'll have dozens of other professors and scientists who read it and scrutinize it and criticize it. They'll write a blog about it or you know, drag me on Twitter. And so there definitely is like a certain set of norms you have to uphold. And they're different when you're a scientist, say, than when you're an author. An author is more expected to like be able to tell stories. You get a little bit more flexibility about like what the evidence is. But when I go back to my other job, I have to actually have very rigorous evidence. And if they find me talking on these podcasts about stuff that's not backed up with science, they'll, you know, my reputation will actually drop. My status will drop. I'll stop getting invited to scientific events. And so for me, I'm often actually trying to juggle those two identities a lot, make sure I'm telling good stories, but that they're backed up by the science. Otherwise, my other identity, the status in that community, will suffer.
Professor Robert Frank was a relatively recent conversation that we had. I thought that one was incredible as well. We covered so much ground. He's done important research for many years now on the link between consumption and happiness, which is something that we think a lot about, and it comes up a ton in the happiness research. So we asked Professor Frank in episode 230 about the relationship between the consumption of luxury goods and happiness. Oh, you say stuff. Say something about what your notes are in there as you grow older and all that stuff. Go on. That's good stuff.
Yeah, the part that really I find intriguing is that as you get older, I find that stuff matters less to me. So it all makes sense. But the part, and I know he pushed back on us about the relativism comment, but he really does get you thinking about policies. And I'm not saying I support the policy, but it makes you think about this relative happiness. And if we could do things from a society level that wouldn't affect anyone's independent level of happiness, but increase society's happiness, I thought that was really, really profound. I know it's not part of this clip, but it's worth listening to the episode to think about that.
Oh, yeah, super, super interesting point. It's like just the idea that individuals can behave rationally in the structure that they are in, but that individual rational behavior can lead to society level irrational behavior. And again, I'm not advocating for his policies, which he was excited to talk about, but conceptually, it's very, very interesting to think about.
When you buy a bigger TV or a nicer refrigerator, you're happy about that. If everyone has a flat screen TV with 4K resolution, then you do quickly adapt to that. Am I happier watching? As it happens, I have a 5 or 7 or 8 year old plasma TV, which seemed really exciting when I first got it, but I can't honestly testify that I'm happier now, because maybe if I go visit a friend who has an 8K TV, then my TV will seem blurry and I'll need a new one. But those things, the link between them, and once you've adapted and once everybody else has them, the link between them and psychological well-being is tenuous at best, and in most cases, not even measurable. The link between many other kinds of expenditure and happiness and well-being is easily demonstrated. My colleague Tom Gilovich has done some very compelling work showing that money spent on experiences has a far more profound and enduring effect on psychological well-being than money spent on goods. People are less likely to have contexts in which they compare experiences unfavorably with the experiences of others. It's just the psychology we've inherited has some asymmetries in it that make us as individuals choose expenditure patterns that don't add up to a very good outcome for us collectively.
Yep. Yeah, we've talked about a lot of Tom's papers. That's fantastic work. You've mentioned a couple of, well, we haven't gotten into it at all, but you've mentioned policy a few times. If we step back from that, what do you think individuals can do to recognize these patterns and maybe avoid them?
You know, a lot of this is local. If you don't want your kids to feel like material things are the be all and end all, there are some cultures that celebrate material acquisition, local cultures I'm talking about, that celebrate acquisition much more than others. And so I think there would be that would be one of the things to factor into the mix of a decision about where to live, who to choose as friends. If you want to be more of a climate advocate, then choosing a peer group that has similar aspirations will make it seem more comfortable with the consumption standard that's consistent with climate advocacy. If most of your friends are jetting off to distant destinations 2 or 3 times a month and you're not, then you'll feel deprived. If you hang out with bicyclists and hikers who vacation on old railroad trails closer to home, you're not going to be less happy, but you'll be better able to live whatever you feel your ideals call for.
Another great guest this year, Ben, was Cornell's professor Vanessa Bohns, author of the book You Have More Influence Than You Think. There's so much psychology behind how we make decisions and a great variance in our levels of confidence when we do make decisions. And in many areas, such as driving, many people are overconfident. So we asked Professor Bohns in episode 206, why are people underconfident in their social lives?
Yeah, this is really interesting. And I think a big part of it, so as you said, people tend to be overconfident in things like their driving and their morality and their intelligence and things like that. And what they show is basically when you are thinking about how smart am I compared to other people, or how moral am I, or how good of a driver am I compared to other people? What we tend to do is we reflect inward. We think to ourselves about, how moral we are, the last decision we made, or the last time we drove, if we're thinking about the driving question. And we kind of just reflect inward. We remember experiences we had, and we tend to do this sort of selective search of those experiences. We come across those experiences that paint us in the most positive light, not surprisingly, because that's what people do. And so we feel pretty good about ourselves in the end. And we say, actually, I'm a really good driver because I remember all these great times that, I navigated these really difficult situations. When we try to think about ourselves socially and kind of look at, how social and influential and likable am I? What we tend to do is, instead of reflecting inward for social categories, we tend to reflect outward, and we compare ourselves to what we see other people doing. And the things that come most easily to mind when we think about other people are the influencers, are the people posting on Instagram about all their, fancy dinners and their exciting social parties and whatever it might be. And so we think of these sort of exemplars of being influential and popular and social. And clearly, most of us, pale in comparison to those exemplars. And so we think, I'm definitely like that. So I'm clearly lower than average on my social ability, right? But in fact, both of those are errors, right? They often say like the average person thinks they're smarter than the average person. And in this case, the average person thinks they're less social than the average person. And they're both errors because that's impossible. But we tend to kind of make this assessment by turning inward when we're thinking about something about ourselves, but outward when we're thinking about, well, how social am I? This kind of social category.
Just in thinking through the time that we put into creating the podcast and even doing a review episode like this, which a lot of time has gone into, it makes us think about someone like Professor Fama, who's just incredibly productive at a level that, I mean, even us doing this little podcast, it makes Professor Fama's work makes it seem tiny in comparison. So we had to ask Professor Fama, how many hours per day does he think the brain can handle real thinking work?
What a career. You think he's been working basically every day for, 55 plus years at this. And to have been that fortunate to have found a career that interests you so much that you want to work that much for so long and have that kind of impact. But also going back to the comments at the top of this episode, to have that kind of impact at a time when so much change was happening. I mean, what an amazing confluence of events to happen in his lifetime.
Definitely.
Okay, that's a very good question. It took me a long time to figure that out. So I would say you have about 4 hours a day. So I'd say over my academic life, I do my work in the morning and I do other people's work in the afternoon, because in the afternoon I'm burnt out. I can't do the original stuff. That my productivity per unit time goes way down. So then what I found out later in life is you can take, this is when I took up golf. What I found out was you can take those 4 hours anytime. It's not important that you get them in the morning. You can go play golf in the morning and get the 4 hours in the afternoon, but then nobody else gets your time. So
yeah, so I love Professor Fama's take on work ethic. And as I said earlier, you can tell he loves what he does and makes him happy and wildly productive. So happiness is another theme that we covered quite a bit again this year. And UCLA's Cassie Holmes, author of the excellent book, Happier Hour, joined us. And we had a chance to ask her, scientifically speaking, why is being happy a good thing?
Yeah, and it's a really important question because sometimes people think of happiness as somewhat of a frivolous thing that might seem indulgent, but it's absolutely not. And I would actually say that the last couple of years, folks have come to recognize just how important it is with anxiety rates, depression rates, burnout rates as high as they are. Everyone has come to recognize just how important our emotional well-being is. To your question of, are there studies to show just how important our well-being is? Absolutely. And research has shown that feeling happy benefits across our domains of life in the workplace, in our interpersonal relationships with respect to health. For example, in the workplace, when we feel happy, it increases our creativity. It makes us more adaptive problem solvers. The happy employees are more engaged and better performers. It helps us in our interpersonal relationships. So when we feel happy, we like others more, we are liked by others more, we're more likely to help others out, which helps us in our interpersonal relationships, as well as if you think of that in the workplace. When we feel happy, we're more likely to help our colleagues, we're more committed to the organization at large. Also, with respect to health, happiness increases our immune functioning, our threshold for pain, and makes us more likely to stick to our treatment regimes, and correlationally, it's associated with longevity. So all of this is to say that, yes, we want to be happy. Like, wouldn't that be nice? And we want to be happier, which I actually think is an important qualifier and the title of my book, Happier Hour, is purposeful. It's not about happy that you turn on yes or no, I am or I am not. It's what can we do to feel better? And so feeling better has these positive consequences.
Cassie's arguments are very compelling. And I mean, we've spent a lot of time on the podcast talking about happiness, but to hear, again, like you said, when you introduced that clip, Cameron, scientifically, why is this a good thing? It's kind of easy to say that being happy is good, but really why is that true? So that's really good to hear from Cassie. Now, to bring us home to the final segment for this wrap-up episode, and I think it's a pretty good way to finish it, we have Commander Chris Hadfield. Chris joined us for an episode based on his book, An Astronaut's Guide to Life on Earth, which is an excellent book. And this is the episode where we had to go back and encourage people to listen to it because the download numbers were lower than usual, and we weren't worried about that. But we thought this was such an incredible episode, we didn't want people to miss it. And when we went back and did that, encouraged people in the next episode after his to go back and listen, we heard so many comments back from people saying, I'm so glad you encouraged me to do that. It's one of the best episodes that you've ever done. And I think that's true. Chris is a Canadian astronaut, very well known in Canada, maybe less so around the world, which is maybe one of the reasons some people skipped it. Anyway, to take us home for this wrap up, we asked Chris what the most important lesson that he learned as an astronaut was that he continues to apply to his everyday life on Earth.
Goals are super important. Having a clear vision of things that you want in your life, things that you want to happen, events, places, people, opportunities, whatever. I think having barely possible or impossible goals, that's a really important thing. But the odds of doing those things are very small. And even if you do them, they're going to be different than you thought. And so I think maybe the most important part of the book, The Astronaut's Guide to Life on Earth, but also my own takeaways from the decades of experience in spaceflight are that what you've done already, you can't change. And the things that you're aspiring to are just theoretical. What matters the absolute most is what are you going to do next? That's what matters. When I say that, what are you going to do in the next 10 seconds? One of my fellow astronauts, Tracy Caldwell, she grabbed a grease pencil and wrote on the wall of the space station, there is nothing more important than what you are doing right now. And it's the truth when you think about it. Your life is not what you set out to do. Your life is just the knitted together series of all of your little decisions of what to do next. And we often forgive ourselves our little decisions. You know, you found that doesn't matter. That's just a little decision, but that's all you got, you know? And so I think the deliberateness of how you make each of your small decisions every day, that is going to be your life. That's going to determine the path of who you are tomorrow. And so think about them, take them, you know, seriously, be deliberate in your own choices every day. And that has something I learned throughout the pattern of training and development that I went through, but also it's something wherever I could, I tried to be mindful of. And I'm still even more so now at this particular phase of life. I think about that a lot.
I'm not sure if there's a better guest to close out this episode than Chris. He was phenomenal to have on. And that's one episode that I share with friends and my brothers and their kids and my nieces and nephews and my kids. I've encouraged a lot of people that I know in my personal circle to listen to that episode, which I don't normally do with other episodes. Anyways, that's our 22 guest in review episode. What a year. Learned a lot, safe to say. Put a fair amount of time into this, safe to say.
Yeah. We did learn a lot. That's one of our early episodes in 2023 is going to be a lessons learned in 2022 episode. So that should be
on the investment side, like on your segment side. Yeah, which would be very cool.
Yeah, so yeah, not a guest wrap up like this, but more of a, and it's like a, I guess well, I don't know, an all encompassing what are the big lessons that we took away from the research that we did ourselves, but also from conversations we had with guests. That'll be an upcoming episode.
Anyways, everybody, thanks for listening. Been a heck of a year. We wish you a great 2023.